I'm Alex Price, Head of Fiera Real Estate in the UK, and in this video I'm going to set out what we're seeing in the UK today and the impact we think it will have for real estate investors. The short-term economic impact of coronavirus is clear: record-beating volatility in GDP, looming job losses, and an unprecedented government stimulus, over $10 trillion globally to date. Within the UK property sector, the lockdown and associated transition to working from home has led to a fall in office leasing, with London down 60% in Q2. The retail sector has also seen a dramatic shift away from physical retailing, as shown by Tesco, who are forecasting a 65% increase in online sales this year alone. The sudden shift is creating the highest level of retail-related corporate insolvencies in a generation, from Into to Debenhams. While department stores and shopping centres may be dying, however, the retail warehouse sector has done pretty well, underpinned by strong store sales, lower property costs, and the potential for last-mile logistics as an alternative use. These edge-of-town units are replacing the high street as the final link in the physical chain for moving goods to the consumer. It's no surprise that Savills are forecasting the need for an extra 14 million square feet of logistics space in the next few years. The residential market is also booming, with prices now at a record high. The housing market will surely slow as jobs are lost in the months ahead, but with the densest and fastest growing population of the main countries in Europe, don't bet against the rise in UK house prices in the longer term. In the immediate future though, we predict a rapid growth in the residential rental market as institutional investors with a low cost of capital seek income-producing, inflation-linked assets. Low required returns for institutions will hopefully lead to lower rents for consumers, although the cynic suggests this may simply lead to an increased land value. Offices will remain a cause for concern, but we at Fiera Real Estate are convinced that the report of the death of offices has been exaggerated. It remains the premier place for innovation, collaboration, and communication, so most organisations will still need accessible, high quality, and flexible space, even if they only go there for part of the week. Finally, in terms of values, the banks have shown a supportive attitude to date, even on defaulting loans, largely because of the limited ability to enforce. With the provisioning for bad loans rising dramatically in 2020, we expect the bank's attitude to change, leading to an increasingly split market next year. In-town retail, leisure assets, or low-quality offices, i.e. assets where income is uncertain, will see falls in value and the banks forcing sales, with the buyers taking those assets forward being the ones able to execute radical transformation. However, where cash flow is more secure, i.e. residential, logistics, or Grade A offices, distress will be limited by the quantum of cheap money, a low interest rate environment, and a growing population.